There was a lot of damage, but at least it wasn't chaotic. A little bit of good news. It was the biggest volume day of the year, and while we closed just about on the lows, the open and close were at least orderly. No big trading halts, no price dislocations at the close, but there was still plenty of damage. The concern was the impact on earnings in four key areas. First, lower rates for longer. Look at the banks. They're facing a double whammy here. Low interest rates and now the potential for slower loan demand, at least in Europe. Morgan Stanley, Citi, the rest of the money center banks all down. But curiously, even regional banks with no exposure to Europe like Zions and Comerica were also down. Second, big tech names like Hewlett-Packard Enterprise, Akamai, and Juniper Networks were down on concerns that a slowdown in Europe could further cut capital spending. Third, retailers like Ralph Lauren and Michael Kors and other consumer names like Cruise Line Carnival Corp and Marriott were down on concerns that consumer spending might slow down. And finally, there's the dollar problem. It jumped up. Strong dollar, big problem because it hurts commodity prices. That hurts material stocks like copper giant Freeport-McMoRan, aluminum producer Alcoa, steelmaker Nucor, and even energy names like Hess and Conoco. Oil dropped almost 5%. All this is a really big disappointment because traders were hoping that the third quarter would put an end to 5 consecutive quarters of profit declines for the S&P 500, and now it looks like it could be 6 consecutive quarters. Ouch. And then we have this election in Spain on Sunday and the concerns maybe we have people involved there who might also want to have a referendum on leaving the euro, and then we relive the whole thing again on Monday. Real disappointment on earnings.
Yeah, real disappointment for sure.